So America just lit the fuse and China has had enough. For many months now, Beijing has been dumping tons of their US bond holdings. Looking at the past year, we can see a consistent sell-off. They have gone from 938 billion down to 835 billion, and in total, they have sold 103 billion worth of treasuries, which is around 11% of their holdings. But why is China selling them like hotcakes? Some would say it's because of sanctions. China is afraid of the United States freezing their assets. Another reason is because of America's endless deficit spending. The borrowing doesn't seem to stop, and this is spiking bond yields, devaluing China's holdings. Now, those are very valid arguments, but just a week ago, America gave China the biggest reason to stop lending them money. During the G20 summit, the United States unveiled a big project. They are working with the EU to back an ambitious plan. They are moving to establish a trade corridor that links Europe, the Middle East, and India together. Obviously, China wasn't part of this grand scheme because it is a plan to counter Beijing's BRI, the Belt Road Initiative. And whether it's a serious plan or just plain blustering, we best believe that China is watching these on the sidelines. In this grand game of economic chess, America is now moving to challenge China in an existential way, which is actually more dangerous than financial sanctions. The United States has tried to defeat China in manufacturing, but that has been an abject failure. Just look at the TSMC plant in Arizona. The Taiwan chip maker is complaining that there is a lack of skilled workers in the United States, and this will delay mass production all the way until 2025, while trade unions are angry that the plant is planning to hire Taiwanese workers, so all this chaos is delaying manufacturing. Manufacturing there is becoming a dead end. The US is now moving to compete with China in global trade, and they are trying to do this by controlling the trade routes. And when you control how trade flows, you gain incredible advantages. To understand this, let's take a quick look at China's BRI. In the first half of 2023, China's trade with countries along the Belt Road reached almost 6.9 trillion yuan, and this is a year-on-year growth of 9.8%, almost double digits. In fact, trade with BRI countries accounts for over a third of China's total import and export value. It is an existential part of China's economy, and America is looking to wrestle control away from Beijing. If America's trade corridor really takes off, this will be bad for China. Trade within the corridor would be done in the US dollar, and this further entrenches the reserve currency's position in the world. In addition, the trade corridor could even impose tariffs or taxes on China's goods as well, further squeezing Beijing's revenues. China's share of global trade could even drop. And because of this, China's most direct counter would be to drop their US Treasury holdings. And let me explain why. When a country issues bonds, they are borrowing money from the open market, and this money is then used to fund government spending. This can be used for healthcare, defense, and social programs. And in this case, it will be spent on financing the trade corridor. Europe is suffering from an energy crisis and high inflation, so this spending will largely be financed by the United States. For example, Biden is moving to back the World Bank to counter China on the world stage. To do this, he is seeking to borrow $3.3 billion from Congress today with a plan to raise $600 billion by 2027. And that is a ton of money, but there's a glaring problem. Interest rates have been rising. We have gone from zero rates all the way to 5.5%, which puts a burden on America's balance sheet if they keep borrowing. This really puts a physical constraint on how much money the US can borrow. And there are two issues with trying to counter China with the trade corridor. The first is digging yourself deeper into debt. To really make a difference, America will have to borrow trillions of dollars to compete, but that will drive bond yields to the moon. The 10-year Treasury yield recently hit a record high of 4.25%, and this is the highest point since 2007, just before the global financial crisis happened. And the more money you borrow, the more bonds you need to issue, which pushes yields up even further. And as yields fly up, that in turn pushes the US economy closer to the brink of collapse. I'm talking about the real economy, guys. Even if Congress can borrow an unlimited amount of money, people on the street will suffer from higher mortgages and credit card payments. And the second problem is pushing your economy closer towards a fiscal cliff. Now, a fiscal cliff simply means the point of no return. And this is when additional borrowing becomes impossible. Your existing debt burden has simply become impossible to service. the interest payments on the government debt have already exceeded 35% of tax receipts. For every $100 of money Congress brings in, $35 is used just to pay the interest on the national debt. And the higher this ratio becomes, the closer and closer we get towards a fiscal cliff. And when we get there, either America defaults on its debt or taxes gets raised to an ungodly level, right? Both outcomes would very well implode the US economy. For decades, China has been buying US bonds. Since 2002, China's bond holdings have grown year after year. It went from $70 billion to over $1.3 trillion at its peak, and that was the golden period of US China relations where it made total sense for Beijing to hold US bonds. But now things have changed. If China continues to buy US treasuries, they will effectively be funding America's Middle East trade corridor. We need to understand this. Buying US bonds means financing Biden's efforts to challenge the BRI, which just doesn't make sense. And this is an existential challenge that China can't afford to lose. Back in 2022, Zoltan Poza of Credit Suisse wrote a very important paper called Bretton Woods 3. And pay attention to this paragraph. For certain large countries in the global east, it makes absolutely no logical sense to roll their investments into G7 debt claims. It will mean funding America's geopolitical efforts against the East. So we can expect China to continue selling off their treasury holdings month after month. And I'm not saying that they'll reduce it to zero, but just the bare minimum to conduct trade and currency operations. And by refusing to buy any new treasuries, China is effectively removing a major bid from the market and making it more expensive for America to borrow money. It puts upwards pressure on US bond yields. And a big shout out to our sponsor today, Tiger Brokers. I've been buying stocks and ETFs for the longest time, and I don't think I've used a better commission-free trading app. Tiger Brokers is a leading global online brokerage that I personally use. Its flagship trading platform, Tiger Trade, allows you to access the global markets with just one account. But what I truly like about this platform is the ability to buy fractional shares. Now, instead of coughing out hundreds of dollars for Tesla or Amazon share, I can build my position with as little as $1. And best of all, you can benefit from higher bond yields with their cash management solution. It's time to enjoy up to 6% yield doing absolutely nothing. No conditions attached. You can withdraw and cash out at any time you want, guys. And yes, guys, you can load up on your precious metals ETFs as well to build your gold and silver positions. So take the time to sign up today. It's time to enjoy commission-free trading as well as awesome welcome rewards that put money into your pocket. And if you're in the United States, the trading platform is TradeUp, which offers you a lifetime of zero commission trading plus free shares value up to $1,800. Everyone loves free money, so sign up for Tiger Brokers and start investing today. Now, this doesn't mean America can't raise any more money. They absolutely can, because the rest of the G7 is still supporting the US bond market. US allies, including the UK, Belgium, and Canada, have been piling on tons of treasury bonds over the past 12 months alone. The UK has increased their holdings by $55 billion. Belgium has bought $59 billion worth, while Canada is the top buyer, stacking on $65 billion. However, what's happening here is a transfer of risk. China's exposure to treasuries is going down, while the G7's exposure is going up. So if a default does happen, these countries are on the hook and the impact will be greater. But there's another reason why China will keep selling, and that's because their currency is falling fast against the dollar. The Chinese yuan has fallen dramatically against the dollar, down by 6% and hitting a 16-year low. While this might be good for exports, the problem lies with rising costs of imports. China buys a ton of stuff like energy and food. A falling yuan increases the cost of imports, which isn't good as their own exports are falling. China is now in the same boat as Japan. They have to sell their treasury holdings to defend their local currency. However, there's a big problem with this. Remember when we said the Federal Reserve has raised interest rates? This means China has also been booking losses on their bond holdings as they continue to sell. Every time interest rates rise, bond values take a beating. And according to Fidelity, when interest rates rise by 1%, 10-year bonds could lose around 9% of their value. A 3% rise equates to a 27% crash in bond values. So just imagine the amount of losses China is booking by selling their bond holdings now. And if you're a bond investor, you probably know what I mean. your bond values are probably down 10 to 20% as well. In essence, China's being forced to eat a loss in order to defend their own currency. In fact, this loss might have cancelled away their gains over the years. And this won't sit well with Beijing because de-risking from US debt is actually costing them money. And that's going to destroy any future incentive to further invest into the treasury market. By holding a ton of US bonds, you are opening yourself up to massive losses every time the Federal Reserve hikes rates. The only solution is not to play the game in the first place. And that's why the Chinese bid for treasuries is going to disappear from the market. They'll be investing elsewhere. And whether you like China or not, this has big implications. China still runs a huge trade surplus with the world, so they have a ton of excess cash. In 2022, China's trade with the world hit a massive surplus of $857 billion. Trade with the US alone accounted for over $400 billion of this surplus, and that is a lot of money, and where they choose to invest it in is very important. So where's Beijing going to stash their money? Well, China has been giving us a ton of clues that are getting more and more obvious. The first destination is of course gold, and this is probably the top spot for China when it comes to building their reserves. In a report by Bloomberg, China's gold binge extends to 10th month as reserves climb. Gold makes the perfect sense for China because it holds no counterparty risk and preserves value over a long period of time. Bullion held by the People's Bank of China rose by 930,000 troy ounces in August, the central bank said on Thursday, and that's equivalent to around 29 tons. Now, I for one don't believe China's figures when it comes to gold. I believe they are understating their purchases and holdings. The country is the world's biggest gold producer, and bullion hardly leaves the country. They are a black hole for gold, so the estimate of their reserves, that 2100 figure, is likely a big understatement. China buying gold for 10 months straight is likely announcing to the world, hey, we are done with the dollar. We are selling treasuries month after month and buying gold instead. And this is a warning that the rest of the world is listening to. Over the past 18 months, central banks have been net buyers of gold, and they have recently ramped up their purchases in June and July, buying an average of 70 tons each month. And remember, this is when gold prices were around 1950, almost $2,000, and interest rates were still rising. Something fundamental has changed, and it's an underlying fear that America's deficit spending is getting out of control. If the US keeps borrowing money at this rate, sooner or later, the bond market will implode. The Federal Reserve will have to step in and monetize the debt and inflate it away with money printing. And that's why central banks around the world are buying gold and why China won't stop stacking as well. So let's understand this. Instead of financing America's own efforts against itself, Beijing is channeling their money away from US bonds towards gold. Inflation is still a long-term problem. Holding treasuries isn't smart for them, so there's only one option left. But gold is just one avenue. China is also going to pour more money into the Belt Road projects. In the first half of 2023, China has invested around $43 billion across 100 deals in the BRI countries. And this is money that is diverted away from risk-free US treasuries into so-called risky projects that could default. And we'll keep seeing China pour more and more money into the BRI deals because it is critical for their survival. The BRI is as important to China the same way the US dollar is to the United States. So even though Beijing is tackling their own property crisis at a slowdown, they will have to invest more money and more money into the Belt Road. And where is this money going to come from? It will be from US Treasury sales. It doesn't make strategic sense for China to fund Biden's trade corridor by stacking more treasury bonds, right? It is counterproductive to buy more. In total, China has spent at least $1 trillion in building up the BRI, and estimates claim it could reach as much as $8 trillion. They are all in with this project, and with Biden's latest challenge, China is going to double down on this. And we can expect China to keep selling their bond holdings because buying more simply doesn't make sense. But let me know what you think in the comments below. How far will China take their treasury down? And where else will they invest their money in? Let me know in the comments below. Stay safe, be sure to smash the like button and subscribe as we navigate through these crazy times.